Hello everybody. So MSTR stock keeps shining, keeps executing super fast. And some of the funds that they raised this week, we are finding out today, likely didn't go towards Bitcoin, but likely went, for sure now that he tweeted this, a portion of these funds went towards buying back the converts, buying back convertible notes, specifically the 2029 convertible notes. And of course you would buy those because they were those trading at the steepest discount. You can see notional 3 billion trading at 2.66 billion. Conversion price was also 672, which means that, they were way out of the money. And therefore, they were the cheapest to buy back. That's the cheapest ones to look at. That's the first logical debt to start buying back. It's only logical. And I ask a question. Is it silly to do that? Well, at first glance, you would say, well, wait a minute, that's a little silly because that money is borrowed at 0% until 2029. So technically, we don't have to worry about this technically until late 2029. So at first glance, you could say that's silly to buy it back. But here's the thing. There's many reasons why I don't think it's silly. First of all, if you think the price of MSTR in late 29 is going to be higher than $672, which is what Saylor most likely thinks, then it makes some sense to buy back that 0% debt. If you buy it back at a discount, so I'll get to that in a second. If you buy that at an 8% discount, so let's talk about the discount. That debt was quote unquote trading below issuance, right? So 1.5 billion, he was able to find creditors to buy back 1.5 billion for 1.38 billion. That debt was trading at an 8% discount. He bought it back at a discount. You see, that's some of the beautiful things that companies can do. Like all of us who are sitting on a 2.73%-ish mortgage, we all wish we could buy back the mortgage, right? Because the mortgage is probably trading at a big distressed valuations. Anybody who contracted debt earlier, like 5 years ago, 4 years ago, we wish we could buy back that debt now. We can't do that as individuals. Companies can do that. They can buy their debt when their debt is trading below par, when it's trading below the notional value. It makes a lot of sense for Saylor to tackle that convertible debt 2029, which is trading at a nice discount, and then you can guess which ones he's going to attack next. Likely the 2030 B tranche, which is also trading at a discount. That's likely the one he's going to attack next. Then we'll see what he does with the other converts, right? But for now, attacking these two makes a lot of sense. It's accretive to the shareholder. You're avoiding future dilution, and you're also buying off the debt at a discount. So that's a pretty big deal. So that's the second reason why you would want to buy back the debt. Can you buy it back at a discount, right? And lastly, and that's going to be more of an explanation when we see him pay a little bit more, like when we see him pay up to buy back that debt, right? Like, for example, 2031, you see notional was 600 million. It's trading at 700 million right now, right? That's 100 million extra. You're going to have to justify that when he gets to these debts, which are no time soon. I don't think it's going to be soon. I think we're going to focus on the 2029 and the 2030s first. But how would you justify even paying more money than what you issued it at? Paying more money to buy back the debt. How would you justify that? You would justify that if you want to create a better balance sheet, if you want to have a more pristine balance sheet. Because when you look at, I'm going to call this the credit stack. When you look at the stack of converts, which is debt, and preferred stock, which is perpetual debt. So it is stock, but it is stock where a dividend is due forever. If you look at the quote-unquote North Star of Saylor, of course, is the BTC rating. Saylor always talking about how even the best big tech companies out there have a rating, a asset to debt ratio, how much assets are actually backing the debt. Is the debt backed by cash flow or is the debt backed by assets? He's saying a lot of companies in the S&P 500, the best you can find is like 1.5, maybe a 2. right? And so that's why his theory is to have at least a free. What does that mean? Free. It means that for every dollar of debt, he wants $3 of Bitcoin backing that debt. And you can see STRC's credit quality actually went up. We have the BTC rating of 4.1x. So there's $4.1 worth of Bitcoin backing each dollar of STRC. But let's talk about the converts. Look at the converts. Look at the 2028. The 2028 are so high in the capital structure. You have $88 worth of Bitcoin backing each dollar of converts 2028, right? The 2030B I just mentioned, you have $29 worth of Bitcoin, right? The 2029 they just bought back, you have $15 worth of Bitcoin backing it up. So what does that tell you? That tells you that as he buys back all of this super collateralized debt, as he buys it back, he gets to recuperate, he gets to recoup that BTC rating, and that BTC rating then flows back to all of the other preferred instruments. So whenever you retire that debt, a lot of that bankability that was going towards backing the converts, which the converts are not really helpful anymore, you take that bankability of the converts and you distribute it back against the preferred stock. So it makes a lot of sense. Every time you're going to buy back the converts here, you're going to increase the BTC rating of the preferreds. And if you increase the BTC ratings of the preferreds will be seen as more safe by the market. And the more safe they are seen, the better the bid on these preferred, the better the bid, or up to him, right? That's his choice. Either the better the bid or the lower the yield, right? If he can also lower the yield eventually. So that's why it's a really big deal. And of course, you see this in action when you consider the high BTC rating of these converts. They pay next to no interest, right? The interest on these converts is next to nothing. Where do I see the interest rate? The coupon, there you go. It's next to nothing. All under 1%, except the 2032s. All under 1%. Now, of course, that under 1%, the reason why you get it is because of a conversion price, right? There's a warrant attached to them when he issued them. But it's likely, for example, for 2029, that a lot of the creditors perhaps didn't really take the warrant into account because it's so far out in the distance, right? So the value of that option is not very valuable. Now, on the other hand, if you look at, say, the conversion by the 149, for example, in that example, they probably valued the warrant quite a bit. So He said it before, but as soon as he discovered the preferred shares, he kind of regretted doing the converts. And my guess is that he's working on that regret, and he's removing the converts, and he's going all in on the preferreds now. And that's a really big deal. I think it makes a lot of sense to do that. A lot of sense. This company makes a lot of sense. And by the way, let's talk about Stretch now. Stretch, of course, had an ex-dividend this morning. So we ex-dividended this morning. The coupon is 0.9583. Therefore, as of this morning, we should have traded at 100 minus the coupon, 0.9583, which you collected on the ex-dividend date, right? So you can sell it in the morning. And it should be trading at 99.04. Now, 1 hour into the trading day, we recovered 15 cents extra. So we are at 99.19. We were at 99. Even at the opening, right? Even at the opening, we didn't get to 99.04. We were at like 99.19, 18 at the opening. So the point that I'm trying to make is the real arbitrage here is not sitting 20 days and waiting until the instrument gets back to 100. Hopefully less than 20 days. Hopefully there's no further attack, and hopefully we get back to 100 in like a week and a half. Hopefully, right? But if you want to get the full 95 cents of monthly arbitrage, you essentially got to stay in the instrument for like 2/3 of the months. Right, and so your yield is very, very similar to the yield of someone who does nothing and just sits on their hands and waits for the dividend. No, the real arbitrage, what I could call, I guess, the zero time arbitrage, is really that 15 cents. Right, the 15 cents between how much money you collect and how much you sell. So you're buying it for 100. Right, you're collecting 95 cents and you're selling it back for 99.20. So really, it's only 15 cents. So really, the zero time arbitrage if I may say, like over the course of the asset, over 1 year, the 0-time arbitrage is probably between like 1.5% to 2% a year, right? Which for a big player, which for a hedge fund is really attractive. For a professional player, it's very attractive. But I think for retail, this makes very little sense to do that. Like in my view, for retail, like what sense does it make? 1.5%, 1%. No, to me it makes, compared to the complexity, to me this makes very little sense to do that for retail. But I think there's the many of the institutional buyers, which are not many, but the 20-25% of institutional buyers of Stretch, they do it for that arbitrage. But to me it's not really worth it. Like it's not that big of a it's just not that big of a deal compared to the complexity, and it's gonna get even lesser of a deal when we move to buy monthly, to twice a month. So anyways, just something to think about. And let me conclude too, and of course this is usual, right? It's like, you think we're gonna have a good year in the 2020s? No, it's gonna keep being frustrating. It's gonna keep being frustrating because of the macro. That's just the way it is. And of course we're grinding up, so many of the stocks are up, but it's punctuated by these periods of fear, these periods of sell-off that are just always coming back. We cannot get our 6 months of quiet and nice. We cannot get that in the 2020s. And case in point, of course, is Bitcoin dropping all of a sudden, deciding to drop 3% on us, deciding to trade like a risk asset. Because I don't know, the market is when will the market get back to its senses? My guess is 2029, 2030. That's my plan for now. I'm not having any hope for this market until the 2030s. I think I've called the last decade. The 2020s are, it depends on your asset, but it's been one of the toughest decades to invest in, frankly. The rates are back at a 1 year high, and depending on what you look at, some of the bonds are really not looking good. Mortgages are really not looking good. So becoming a realtor, being in the real estate business has been a great move to be bankrupt in the 2020s. Great move. We are at more than 5%. Everybody's spooked by the long rates. And of course, they're spooked. Why are they spooked? Because they think Kevin Warsh is going to keep the rates high. They think he may even want to increase the rates. And, this is always that question, is like, will the Fed chair be dogmatic and, race us towards a 1930s style recession because they are dogmatic and they want to, save inflation, right? They want to lower inflation. They're dogmatic because they think they control inflation. Now, the truth, of course, if the past few years has been any indication, is that the Fed does not control inflation. The Fed can only kill the economy, can only destroy jobs, destroy demand, but they don't control inflation. So we need a Fed chair who's just going to let go of inflation and understand that inflation is going to do its thing. Inflation is natural. Yeah, sure, the short-term inflation is a little high, but then we have technological innovation coming, and that's going to create a lot of deflation. And you just have to realize that. We'll see if he's dogmatic or not. Kevin Warsh was nominated, right? So we'll see if he is dogmatic or not. But in my view, I'm still very upset about the Fed. I'm not the only one, right? It's a typical Bitcoiner take that we shouldn't have the Fed. Or if we actually control the money supply, it should probably be like a nationwide election where we all get to vote, right? It's a nominated official. It's not an elected official. Like, anyways, I think as we move towards in a few years, the Fed will be a non-issue because at some point the rates will be zero and they will be kept at zero forever because that will be the only way. And that's at some point. That's coming up at some point, maybe with Kevin Warsh, but it's going to take a few years to get there. So anyways, pretty frustrated again today about the macro. Today, bad macro day, but over long term doesn't matter. This was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching and have a wonderful, wonderful day.